What is good, everyone? I know I am coming here on a different day than usual. I also had to get my hair cut, It was getting pretty long, but I kept the top for that length because finally I've been able to get it cut and get to the style I've been wanting. So that's not the reason why, though. There's a difference in day of why I'm doing Kingdom Economics. I was just saying that's my hair that I had to change up. But I actually am going to be doing this on Fridays instead of Saturdays. And I'm going to be publishing it in the afternoons. So today, you're going to receive it not on the Friday or Saturday, but the next one will be. So that way, which is going to be for you all tomorrow, I'll be putting that second video out to getting back on schedule because I'm only catching up for this one video as of last week. Though, the great thing is, this month is about accountability. So I'm holding myself accountable, and hopefully you hold me accountable for continuously providing you this awesome content. But before we begin, let's go ahead and get into prayer. Father, we come before you in the mighty name of Yeshua HaMashiach, as you are great and greatly to be praised, as you are the Elohim who was, who is, and who is to come. And we ensure that your will is being done within Kingdom Economics, and that there is no astral traffic or trading, that we will not be hindered or checked by any outside forces, so that way what you want to have done in our lives will abundantly manifest to show you and your kingdom, so that way you become one in us and we become one in you. We pray this on your mighty name, Yeshua HaMashiach, Aleph Tav. All right, so what do we have going on for accountability this month? Well, as a disclaimer, before we begin in the beginning, if you've ever seen that. Anyway, as a disclaimer, I'm not an attorney, lawyer, tax accountant, financial advisor, any areas of those expertise that you are needing guidance in, contact your professionals. They'll take care of that for you. This is purely for educational purposes. But as Kingdom Economics is about biblical principles and spiritual alignment with one's identity in Yeshua, we're focusing this video on portfolio mandate and financial projections. Now, when it comes to something like this, there's not a lot of talk about the mandate. Now, projections is a big thing, and I'm going to definitely get into that. I'm also going to break it down for you, so that way, not just the portfolio mandate, but also the financial projections make sense for those that have not even heard about stuff like this. So, first we're going to talk about portfolio mandate. Now, with a portfolio mandate, this is something that a lot of family offices do. And a lot of the wealthy people ensure that the portfolio that they build does not go outside of those boundaries. So they are establishing boundaries in their portfolio in order for it to grow effectively, and it does not regress. And I'm going to go and cover the different sections that wealthy families use to build that. So that way you too can do the same thing. It does not matter the level of financial acumen that you have. It just matters of you receiving the knowledge, understanding it, and then being able to apply it in your own life. Because you don't have to have hundreds of millions of assets and capital at your disposal in order to build a portfolio mandate and project financially for you to actually grow it. So you can start from zero doing this. It's just a matter of putting together the right things. What are they? Well, first we have the investment objective. Okay? Capital growth, income generation, capital preservation, absolute return, and so forth. The investment objective in these areas is on the basis of what you are really looking to ensure will move that portfolio instead of just the specific investment type. This is the number side of things and how the numbers are really moving. And we'll get into the investment type, like asset type, in just a moment. But this is on the basis of where do the numbers go and how are they moving? And that's what the investment objective is about. The next one is going to be risk tolerance and constraints. So this is more the boundary side of things, so that way your portfolio doesn't go down. Well, you're going to have maximum drawdown allowed, volatility targets, liquidity requirements, time horizons. This is going to be more on the it's going to be more towards your, I'm trying to look for the right word so I don't inundate you with large vocabulary. Because a lot of you that hear things like drawdown or volatility, that's not going to make as much sense when you're just starting out. So just think of this as more of the, like I said, boundaries. That's the best way I can really describe something when it comes to risk tolerance and constraints, because you are managing the investment objective to not go outside. It's essentially giving you that safety net. The time horizon is something that is on the basis of what's really happening in the economy. It doesn't have to be specifically what you are wanting to have done at a specific time. You can if you want. That's definitely possible. There's nothing wrong with that. But the more pressing matter is on when things happen in the economy, when things happen in the market. That's more of the time horizon, because there are certain times you can do things with investments like real estate when you already have property in the works and you've shown some capital that you're able to use and you've already put your down payment in and you're already looking for investors. Well, there's a time crunch that they have to fulfill in order to be involved in that deal before it actually closes. Otherwise, they can't get in once the deal closes, and usually it's about a 30-day period once you're going into the closing process. I'm not saying that's the only thing. I'm just giving that as an example, as a time horizon. Well, liquidity requirements is also on the basis of how much is really needed for that type of investment. Volatility targets is on the basis of how much risk are you willing to take in your portfolio for it to grow without affecting everything else. That you have that amount to work with, where you know that you're going into something that is going to be a bit chaotic at first, but even though it looks chaotic, you have your skill sets knowing that, hey, I know where it's going to head. You're willing to go up to a certain threshold for that volatility. Because volatility, I'm going to tell you right now, is a little bit different in certain economics, but on the portfolio side of things, I'm only make it more simplified here. And a maximum drawdown allowed is going to be how much can you really draw down? How much can you really go down to your capital before saying, this is the fine line. So that's the best way I can really describe risk tolerance and constraints. Another one, though, is the asset allocation guidelines. Okay, this is more the investment type, the business specifics. So allowed asset classes, like equities, bonds, alternatives, minimum and maximum exposure by asset class, geographic limits, sector or style preferences like value, growth, etc. Now, the allowed asset classes isn't on the basis of like, oh yeah, you can only work with these assets or you can only work with those assets. Now, certain investment vehicles are structured like that, where you are constrained to certain investments. And unless that's your preference and you can have that type of account, it's not exactly fluid and it's not really flexible. And those of you that are wanting more flexibility, I would not recommend going to something that really says you can only invest in these things. Now, it doesn't mean that you can't invest into those things if it says you can only invest into those specific asset classes. But I would recommend having more than just that and having other investment vehicles so that way you have that flexibility. Like, for example, you could use, instead of a 401k, which is not flexible, you can use a IRA, or like what a lot of wealthy people do is they create a self-directed Roth IRA because it's tax-free retirement vehicle that they build the capital up through there, and as a self-direct, and that's because it's the Roth side, the tax-free. The self-directed is on the point of you get to decide which investments go into that retirement account, into that investment vehicle. It can be a retirement account, and because there's certain stipulations. But the IRA is an individual retirement account. That's what it's termed as. But self-directed means you determine what investments you want to have going there. And one of the things that a lot of wealthy people do is that when they build up to a certain amount of capital with their IRA, because you can do just a traditional IRA or a Roth IRA, a lot of times they will focus on a self-directed Roth IRA, and they will create a fund like hedge funds, private equity, venture capital. They don't manage it. They will hire someone or they know someone that they'll bring on board to manage their fund. And so they have their IRA create the fund. And the manager, the investment advisor, could be an exempt advisor, manages that for them. But they own the fund, and they are the ones that say, this is what I want to have done, this is where I want it to go. You, manager, you're going to execute this. And they're like, okay, we're going to execute it, and here are the fees, and here's what we're able to achieve each step of the way. That is what we're looking at for asset allocation. Minimum and maximum exposure by asset class. This is meaning how much risk do you want to take and how conservative do you want to be about what investments you hold. Geographic limits really just means where do you want to really go to for your investments. That can be like, hey, I only want to invest into Southeast Asia. Maybe I want to only invest into Europe. Maybe I want to invest into only Central America or South America, or maybe I just want to be in the U.S. I do not recommend only one country, and specifically, I do not recommend your home country only when you have enough capital to work with, because when you have enough capital to work with, I do recommend expanding into other countries. So that way you have a diversified portfolio that does not get tarnished, because your home country will come into difficult times, and you always want to go to profitable and prosperous countries and keep moving that around. So geographic limits Really just depends on where you want to focus your investment. Sector or style preferences like value and growth and others that you can really focus on is on the basis of what is the type of return you're looking for. Are you looking for something that is going to generate you something every month? Are you looking for a lump sum after a certain period of time? Are you looking to get equity? What is your sector or style preference for this asset allocation? But let's go ahead and take a look at now a benchmark, because this is what's going to help you determine the path you're going to stick to. So benchmark, you could use things like S&P 500, MSCI World, Barclays Aggregate, blended benchmark, or a hybrid model. You can use to measure manager performance as well. Now, I gave these as examples where you can have blended benchmark or a hybrid model, which I more recommend than just focusing on Barclays Aggregate or MSCI World or S&P 500. You can use those. There's nothing wrong with that. What I'm saying is better to have a blended or a hybrid model, something where you believe that it's going to benefit your portfolio. That way, you stick to that benchmark, and that benchmark does not change. And that's not the boundaries per se. That's just to say, here's the path that I'm on and what I'm following. This is my trajectory because this is the benchmark that gives me that outcome. Now, investment restrictions, where you could say you want no derivatives, no leverage, sustainability exclusions, concentration limits, which are like, no single holding of greater than 5% in a certain account. Investment restrictions is another type of boundary. This is on the basis of more specifically what you don't want to have happen in your portfolio. So more than just a broad term, like when we were talking about risk tolerance and constraints, this is more specific towards those boundaries as what specifically you don't want to actually happen in your portfolio. And there are consequences that will happen for those that do not follow what you have established. Now, of course, there is reporting and governance. How frequently do you want to report? Do you want to have a report of your account, your portfolio? Do you want monthly, quarterly, semi-annually, annually? Depending on the structure that you have built up is what you really want. There's no really need for weekly or daily. It's very rare to usually have a monthly report or an annual report. Usually it's quarterly or semi-annually. Those are the more frequent reports. However, you also are going to have performance metrics in there, and you're going to have compliance checks. This is so that way your portfolio is going to continuously be maintained without it just being left on autopilot. All right, just leaving something on autopilot and not getting back to it is one of the biggest mistakes that you could ever do with your portfolio. You always have to have it maintained. You can have it on autopilot up to when you're going to be doing maintenance. Turn that autopilot off, go through the checks, make sure everything is still compliant, make sure it's still performing, making sure that everything is good to go, and then turning the autopilot back on. Okay, you can do that, but just don't have autopilot on all the time, expecting it and always just go in the direction you want it to go and say, hey, manager, just do all this for me, and then come to find out 10 years later that they took like half of what you made. So always make sure that you are going back to check on it. Now, an example that we can take a look here. Now, let's say we look at a balanced mandate. Well, the objective would be moderate growth and income. Allocation could be 60% equities, 40% bonds. Benchmark could be 60-40 world blended index. And your constraints could be like no leverage, no emerging market debt. Now, in something like this, you would not be able to build a hedge fund. That's just a 60-40, and having no leverage, you can't do that. because hedge funds work with leverage. So that is not one you would work with, but you would be able to work with, for example, private equity. You don't have to have leverage involved in private equity or venture capital, where 60% equities is from the businesses and then 40% from the bonds that they issue. And there, you could have something like that. You also could have an equity mandate, so specifically equity, where the objective is long-term capital appreciation. Your sector is going to be developed market equities only. Your restrictions are no fossil fuels, tobacco, or pharmaceuticals. And your benchmark is the S&P 500 historical performance. This would be more in the basis of stocks than anything else, because that's what it's regarded to. Not saying it's the only one. I'm just, again, giving these examples. Like for another one, absolute return mandate, where you have the objective is plus 5% above cash with low volatility. Your tools is multi-asset, derivatives allowed for hedging. Your constraint is a max 8% volatility or a max 10% drawdown. And your benchmark is U.S. Treasury bond market. So these are 3 examples to look at, hopefully giving you ideas what you can do to build your portfolio that keeps you accountable, and it keeps those that manage it for you accountable as well. This is one of the biggest things that people do not talk about, that does not get enough input. And this is why you will have a very difficult time finding the right investment advisors or exempt advisors. Okay, you don't have to have someone who has to be licensed. They can file with the SEC to be an exempt advisor, which still gives them the ability to work with you privately. So they don't work publicly with just a retail and be like, yeah, hey, I can advise you on doing this. No. There are some licenses and regulations they have to follow based on that. But when it comes to private clients, under a certain threshold, which is usually about 150 million assets under management, you are able to be an exempt advisor. So you can work with exempt advisors that work with less than 150 million in assets under management. And so they're going to be giving you things like this, those that are seasoned, that have the skill sets in order for you to build your portfolio mandate the correct way. So you do not get messed up with what you've been wanting to grow. And you always want to find the ones that can see the patterns of how markets have worked historically. So what we're going to focus on next is the financial projections. Now, financial projections, I'm going to be giving you on the basis of what a single business would be doing. So not specifically on like the portfolio, but more so on the actual business, let's say, that you do have. Because a lot of people that start up with a business don't realize that they are able to project their finances and think that they need to stick to a budget. Well, you don't grow if you don't have a financial projection. Just like the weather gives a forecast, all right? It's just like that. You stick to that forecast, that projection. Doesn't mean it's going to be 100% accurate, but it does mean that you are able to move forward, making it happen. So we look at revenue forecast. So the structure that we have here, list primary revenue streams, estimate units sold times the price, and apply expected growth rates. So an example, like an annual projection of the first 3 years. Well, in the first year you have, say, 10,000 units sold, $50 per unit sold for its price, and then you have 500,000 revenue. Say in the second year you sold 13,000, same price, revenue is 650,000. And third year, let's say you sold 16,000, same price, you earned 500,000 with that revenue. Well, that's a revenue. Now we got to look at the COGS, which is the cost of goods sold. So this is where we're going to be looking at like direct materials, direct labor, production, fulfillment costs. We're going to take the same 3-year period. Well, let's say the COGS percentage of revenue first year is 40%, second year is 38%, third year is 36%. Well, that amount, cost of goods sold for the first year is $200,000, second year is $247,000, third year is $288,000. But we're not done, okay? Because we need to look at the gross profit now, all right? The gross profit is going to be your revenue minus your cost of goods sold. So an example like this would be, okay, we're using throughout this example a 3-year period. So first year would be $300,000, second year $403,000, third year $512,000. Hopefully you're with me so far. If you need to pause this and go back, do it. All right. Now, the other part is going to be your operating expenses. So this is not the cost of goods sold. This is what's known as OPEX, operating expenses. So this is everything that is being paid for, like salaries, marketing, rents, software, tools, insurance, admin, legal, okay? We'll say first year paying about $250,000, second year is $300,000, third year is $350,000. Now, this is where we're going to get into your EBITDA, or your operating income. EBITDA is earnings before interest, taxes, depreciation, amortization. That's what EBITDA is. And EBITDA is your gross profit minus your operating expenses, OPEX. So in the first year, we're looking at $50,000. Second year, we're looking at $103,000. And third year, we're looking at $162,000. And if you need to write these down, you definitely do that as well. Now, the net income is where you're going to subtract interest, taxes, depreciation / amortization. Because you might not always have amortization, but you could. Depreciation, yes, you'll usually have in there. So first year, say $35,000. Second year, $72,000. Third year, $120,000. Now, when we're looking at the cash flow projection and breaking that down, which is your operating cash flow, your investing cash flow, your financing cash flow. First year, because we look at inflow, outflow, and net cash flow. The first year cash inflow is $450,000. Your cash outflow is $430,000, so that means your net cash flow is $20,000. In the second year, say you're at $550,000. Your cash outflow is $510,000, and your net cash flow is now $40,000. And then in the third year, we see it increase to $640,000. Then your cash outflow, let's say, is at $580,000. That means your net cash flow is going to be $60,000. Now, here is the point that a lot of people miss when in a startup. You need a break-even analysis. All right? You are not going to be profitable in most businesses in the beginning. Now, unless you provide a service, like let's say as an attorney, this is more on the basis of your writing skills than anything else. This really doesn't take a lot where you need to set up a whole entire office and employees and the whole infrastructure. You don't need to have all that set up. You can start out very minimally and build from there. But let's use something a little more like an e-commerce business, because e-commerce, the whole point is to brand out into storefronts and not just sticking to online only. Online is great. There's nothing wrong with that. But if you stick to online only, what happens if your server gets hacked? What happens if someone takes your website and you can never access it again? A lot of problems that can happen there. There's a lot of problems that can also happen when it comes to having a storefront where business can get burned down to the ground. You have someone rob the place. So there's going to be challenges on both ends, but you don't want to just stick to online only or storefront only. Having both is going to be absolutely essential. But when we look at a break-even analysis, this is where it's going to be your fixed costs divided by the number, which is going to be your price minus your variable costs. So the number that is your price minus variable costs is going to be divided by your fixed costs. So of course, in the parentheses, you PEMDAS, you take care of price minus variable costs first to get that number, then divided by your fixed costs. That will be your then break-even analysis. So let's say your fixed cost is $250,000. Your price per unit is $50,000. Your variable cost unit is $20. So your break-even units is 250,000 divided by 30 equals 8,334 units. This is how you're able to project these simple pieces of information for your business to effectively move in the right direction. This is something that you're able to do in the beginning, and you need to do it yourself. Do not hire an accountant. Do not hire someone to take care of this simple information for you. Do not have your tax accountant do this when you're starting out. You need to know how this works, because if you don't know how this works and you're going to sell your business, no investor is going to want to buy from you because you're going to have such a messy cap table. And that's the last thing that you want, a messy cap table, which means that the financials of your company is all over the place and you look like a horrible company that no one wants to invest and buy into. You don't want to be in that position. Now, it doesn't mean that you don't have great sales and you're being profitable, but when you don't have a clean book that shows a cap table to the investors, when you go to sell your business, you're not going to be able to sell. And it's going to cost you a lot more to get that fixed later on than learning the basics now and then transferring that to an accountant or to your tax advisor or someone that's going to be a bookkeeper for you. Do it after you've learned the basics and have done it consistently. Because then you can see if someone you hire screws up too many times, you know how to fix it and go find someone new. And at the same time, when you go to sell your company, you'll know what to do. But that is what we have all for today on the basis of accountability, because next week, which is technically this week, we're going to go over relationships and culture, because that is absolutely essential when it comes to accountability. I did briefly talk about that at one of the very first calls, but I'm going to go more in depth with that because it is absolutely crucial for the core foundation of why you do what you do. Okay? Not the only thing, but a major one. However, what we are going to do here today, I am going to pull up, hopefully, I do have, yes I do, okay, some scripture to close out with us. So I plead the blood of Yeshua over this word, over this video, and I impart it with scripture of Proverbs 27 verse 12, which says, "A prudent man foresees evil and hides himself. The simple pass on and are punished." And we shall move into Luke chapter 12, verse 48, which says, "But he who did not know, yet committed things deserving of stripes, shall be beaten with few. For everyone to whom much is given, from him much will be required. And to whom much has been committed, of him they will ask the more." And we're going to go ahead and flip over into Romans 14:12. "So then each of us shall give accounts of himself to God." And last but not least, Hebrews 13, verses 5 and 17. "Let your conduct be without covetousness. Be content with such things as you have. For he himself has said, I will never leave you nor forsake you." Verse 13, "Therefore let us go forth to him outside the camp, bearing his reproach. And I seal these scriptures in the blood of Yeshua, in every realm, age, timeline, dimension, frequency, vibration, sound, energy, planet, cosmos, constellation, universe, past, present, future to infinity. All infinities of infinities and beyond, all eternities of eternities and beyond. All times that exist once existed and could or could not exist. On all sides of creation, everything in between. In all multiverses, from the beginning across eternity. In Shemaim, in the heavens, on Haaretz and under Haaretz. Aleph Tav. All right, everyone. It's been a pleasure. As always, I will catch you all out on the next video. So until then, peace.